still think that by the end of this hour. I'll give you this short version, and then anything that piques your interest, you want to dive in deeper, we can go there. So I grew up in Utah. I did a finance degree for my bachelor's with the intention to go into international commercial real estate. That's what I wanted to do back then. That was what I did my internship in between my junior and senior year of college. I worked with a commercial real estate firm out of Seattle, and they were wheeling and dealing in skyscrapers and shopping malls, both domestically and internationally, and had a blast. Life took me down a little different path after that. By the time I graduated from college, we did something a little smaller scale, but we still had the opportunity to work on some pretty cool projects. We were doing a little bit grittier stuff at the beginning with some what we'd call vacation rentals today, Airbnb style before that had become a thing. We were based in Utah. We were doing some vacation rentals in upstate New York and Southern Illinois and places like that. There were some vacation destinations for an audience that we had the ability to market to. And then we did a development project in Southeast Illinois as well, where we built a retail store, some hospitality suites to it, a cafe and a retail store in there. So I got to live on site in that project for a little while and raise capital for that project. Our main investor on that one was actually from Tokyo. So we got to go over there and visit with him and lay out the business plans there and come home with a check for that project. My family and I, we moved to Texas about 12 years ago. And there I started doing some more typical stuff like fix and flips and building up a rental portfolio, some wholesaling as well. And I did that for a while, and I realized, okay, that's not really my skill set. That's not something that's suits me best. And so it was kind of a thought process of where do I go from here. And it was kind of some light bulb moments that led me back to commercial real estate. And I started going down the route of putting together my own operator group. But in that process, after I had invested in a couple deals as a passive investor, was talking to one of the groups that I had invested with and discovered an opportunity there to help them raise capital for their deals. And that for me sounded great. It resonated really well for me. And so that's actually what I've created here with Sugar House Investments. We're a private equity group that raises capital for other operators that we partner with. So I'm actually at this point, I'm a licensed securities broker dealer, which means we focus. It's just a fancy way of saying we raise capital for other operators. I try to keep that short, but that's kind of my path in a nutshell.
Keep it long. We don't care. I mean, that sounds very, very interesting.
Yeah, juicy details, man. Juicy details. That's how we're gonna learn. How we're
All
gonna
right.
get right. So let me ask you this, man. You went through all that stuff. Like, what was the reason that I asked this to everybody? Is like, what was the reason that you chose real estate as ultimately your long-term career path? Because I think everybody's reasoning is kind of different. They always have that same because it's the one that produces the most wealth across all industries, but also everybody always has their own unique reasoning as to why and how that came to be.
Yeah. I don't know exactly the moment. I know when I was growing up in a small town, rural Utah, one of 9 kids of a high school teacher, right? There wasn't a whole lot of money. And it was always this thought process. How do I get out of here? Like, how do I make it big? I was enticed by the ideas of living back east, doing something cool on Wall Street, going to somewhere a little more with more energy and opportunities. And in pursuing those kind of thoughts, reading the stuff I was reading, you come to find out that more millionaires are made in real estate than anywhere else. And pretty much every millionaire, anybody with money, has some real estate in their portfolio. I didn't see myself as brilliant, right? I wasn't going to invent something new that was going to, change the world. That's not where I'm coming from. I look at real estate and saw that it was very repeatable. You can imitate what other people are doing very easily. You're not, and copycat that process. You have a product, you make it better, you make it attractive for people to live there or want to rent it from you. And in doing so, you provide a good product. It's a good service. Your value goes up, and then you can sell it down the road. So should you choose, the tax code is written to benefit owning those type of assets. And so for me, I looked at that and thought, I can do that, right? I'm not the smartest guy on the planet. All right, I'm not going to cure anything. But I can go do that. And so it was, again, I had no clue how to get into that. It was go get a college degree in finance and go into down that path to learn. That's how the only way I could see myself getting into it. I didn't know how, this is before YouTube, right? This is before, meetup groups. So that was the route that made sense to me at that point. So yeah, I guess bottom line, it was money, an opportunity to put, to earn, the type of lifestyle that I wanted to create for my future self and my future family at that point.
And there was a time before YouTube. Is that what you're telling me?
You know what? I had to change the headlight I wanted to change the headlight on my car about a year ago, and I couldn't figure out how to do it. And somebody younger and smarter than me said, "Dude, just go to YouTube. There's got to be a tutorial for that." And that's the first time I realized, oh my gosh, you can learn anything on YouTube. Yeah, man, I'm late to the game on that party.
Oh, I love that. I love that. Man, well, that's awesome. Yeah, and you really pointed out some really, really good points as well, right? You touched on the tax benefits and the tax incentives that there are surrounding real estate. Always a really, really good reason to get into real estate there. You also talked about the fact that you can repeat it, right? You can go and copy and paste what other people are doing and achieve similar or the same results. And for everyone, I apologize. I'm in the car. KJ is going to a bachelorette party, so it was a little bit different today. I had to drop her off, and now I'm going to the in-laws. So I'll be out of the car in like 5 minutes, but just wanted to say I apologize to everyone for that. Okay, so we got an understanding as to why you did it, but what specifically about the being the raising capital, right? What was the reason that you chose to go the broker dealer route versus like a lot of people do, is just being a general partner that raises capital outside of that? And obviously we know there's a lot of different legalities surrounding that particular area. So maybe if you could just talk about a couple of those things and why you chose to go the route you did.
Yeah, I'd say a lot of it just has to do with where I'm at now in my 40s and the lifestyle at this point. In my 20s and 30s, I was used to working those 60, 70, 80 hour weeks and hustling, doing whatever you can, burning both ends of that candle. And so, when we were in Austin and we were doing the fix and flips and wholesaling, right? That's your hustle. And then we have a kid, right? And then, all right, how much hustle, how much time, bandwidth do I have at this point? How can I simplify this a little bit? I started when I first did, a couple of passive investments in larger commercial deals. I realized like my returns there were solid, right? And for, those were beating some of my own personal rentals that we had without any of the hassle. I think I could make more money each pop on a fix and flip, but with a lot more work and, taking up more brain space. But it was generating really good returns for me just as a passive investor. And so then in thinking about, all right, well, I want to scale this, I started going down the road of putting together an operator group, but realizing this would be, this is now a company, right? It's not just a lone wolf activity. You have to put together a team. You need different skill sets, and it is now you're responsible for other people's money. It's going to take a lot of brain space. This becomes another hustle culture, right? Another hustle requirement. And so it just spoke to me with where I was at with, being in my 40s, having some young kids. We had kids late compared to, our peer groups. My little boys are 7 and 4 at this point. And so, thinking about where I could generate the type of returns I wanted to do, I wanted to generate without being away from my kids as much as, running my own operation was going to require. The raising capital component spoke to me. And so then it was, how do we do this in a proper way, right? You've got a few options at this point. Some people just go out and do it, and they get paid a percentage of dollars raised without being licensed. You can get your hand slapped for that pretty significantly. So then you've got the co-GP model, you've got the fund-to-fund models, or you've got the licensed broker dealer route. The licensed broker dealer route, for me, that felt really authentic, right? I'm not a financial planner, but it puts me more on the side of a financial planner, more on the side of the table with the investors than on the side of the operator. I can be really transparent in how I'm compensated. I look at it from the lens of the investor. I have to make sure I understand them, where they're coming from, their experience, their goals. Is this a suitable investment for them? Instead of just having, one deal as an operator, like, here's what I'm raising for today. I've got multiple options. Here's these several operators that I work with. This is a single asset. This is a fund. This is a apartment complex. Here's a self-storage opportunity. So I can present a few different options to my investors, trying to find the one that is most suitable for them and for their goals and their needs at any given point.
I like that. I like that. There's definitely some really good things that you said there. So let's talk about the options, right? Just because I was going to ask you something else, but that kind of piqued my interest there. So it sounds like your business as a whole, it sounds like you've chosen to go the route that's mostly geared towards the specific investors rather than the operators that you're working with or around. Is that kind of a reasonable observation?
Yeah, in a sense, right? I mean, it all starts with, I have to have that solid relationship with an operator who I know is going to do well for our investors. But yeah, I'm a licensed securities representative, right? So it's not unlike, before, again, 20 years ago, if you wanted to buy a stock or a mutual fund, you had to call your stockbroker. That's kind of my role with these securities. When you syndicate, you've created a security, and that, so I've with that broker dealer license, right, I can help you sell that security to an investor, and that I end up being that kind of a advisor role, a go-between, that kind of a stockbroker type of a function to work with an investor who is looking to place capital within this space. Did that answer your question?
Yes, it did. And basically what I was trying to point out, which I don't know if I did a good job of it, but you did answer the question. But what I'm getting at is that it's essentially always about the investors, right? It's always about our investors, whether you're the licensed broker dealer or an operator or whatever else is that you're doing in the space. You want to make sure that you're taking care of the investors first, because otherwise you don't have a business, right? That's the entirety of the business, is your investors and the people that you've cultivated relationships with. So that was kind of like the main
100%.
point I was going at. But you answered the question very well.
Yeah, I mean, at the end of the day, right? None of these deals get done without the people behind us backing it, the investors who are, providing that liquidity, the equity that we need, the capex to go in there and get these deals done. So, yeah, and you do well for them. That's your current investors that you just did well for. That's your best source of future funds, right? So yeah, you absolutely want to take care of them.
Absolutely.
Do you feel like because you had started as a limited partner yourself, that made you a little more empathetic with any of the investors that you work with now?
100%. The fact that I didn't have to go to a friends and family route. I could go back to people I had associated with in my journey over the last 15 years, now 20 years, and saying, hey, I've played in this real estate space for a long time. I've discovered a new route, right, called this limited partner passive investor opportunity. But yeah, when I discovered that, it was, well, I need to go there and experience that myself. How does that work? And so I placed funds with a couple different operators. I learned, my very first deal that I did as a LP has been the worst deal I've invested in yet. It was horrible. It was painful. Learned so much about what not to do. It was a mediocre operator. I didn't know that at the time, right? I learned more about what makes a good operator versus a not good operator. It was a property 2.5 hours south of Houston, not a high growth market, right in the pathway of the hurricanes. Everything that could have gone wrong with that one has gone wrong. And then from there, that fine-tuned my decision-making criteria and how to really select good operators, learn from that. So then I can go back to now my potential investors and tell them, I've got my own battle scars, right? I've got my own lessons learned. I sit in your seat in the past, and currently I invest alongside you in each of these deals, so that we're hand in hand, arm in arm, in these opportunities. And I think that's helped, me paint a really authentic picture to them as we're discussing these.
Yeah.
I love that. Yeah, and it's super powerful. Like a lot of people that are getting into this space don't realize or maybe even appreciate, I don't know what the best word for that is, the fact that when you put your own money, or if you don't have money, putting like your family members' money into it, like that shows a certain level of commitment that you believe in whatever the investment is that's going on, and it's going to help those same investors feel more confident and comfortable investing in that endeavor with you as well, knowing that you're putting your money where your mouth is, essentially. So yeah, I love that. I love that.
Absolutely. And at this point, I do have several friends that are in some of these deals. And one of the first, and whether it's friends or other people who I'm just meeting with, one of the most common questions is, all right, how much of the operator's own personal money are they putting in? And the next question is, how much money are you putting in, Brad? Are you involved? And so, yeah, the fact that they're putting in a bunch, I'm putting in my contribution right alongside you. Yeah, we are buckled together. We're going to go through this journey together. And I'm on the same side of the table as you, as a limited partner. That that I think that provides a lot of comfort and confidence. I try really hard to make sure the investor has the full knowledge they need to make this decision for themselves. I want them to understand how we did the due diligence, what these numbers mean, what all this jargon is actually talking about. But I do know at the end of the day, when they ask me, so Brad, are you in on this one? They're making a decision based on, their confidence in me. Right. And so that's a big responsibility. And so, but that does provide a level of comfort and confidence to them to move forward to that point.
Mm-hmm.
Have you ever had someone have you ever answered like, no, I don't have anything in this, or I'm not planning, and they still wanted to move forward with that? Or has that situation ever come up with for you?
No. So when I put out a deal to our investors, it is only in an opportunity where I say, yeah, I want to be involved in this one myself. And so every deal that we present from Sugar House Investments, me, Brad Shepard, and my wife, we're going to have a chunk of our money in on that deal as well, so that I can say, yes, we're in on this one. And on the operator side, from those general partners, I want them to, I want to know, all right, what are you guys in on this one for? Right. As well. Cause I know those questions are going to come up. And it's not every deal that I can write a check for $50,000, right? So it's not like it's to that same level each time, because we do, 1 or 2 deals a month. And so like, yeah, I don't have that much capital, but I'm going to have, a chunk in each one.
Oh, that's awesome. So let's go towards kind of the legal side of that, right? So being a broker dealer, do you have any rules or regulations that you have to follow when investing as a limited partner, or on the flip side, being a general partner potentially? And is that something that you're currently doing?
So many regulations. Yeah. So I had to go do a bunch of it, take a bunch of courses and take those tests, do all the background checks and the fingerprinting and all that stuff. And then, every email I send out, I have to get my broker dealer's compliance team to look at it and review it and approve it before we send it out. Of course, all the PPMs, the marketing packages, the drone video that we're going to send out, they have to, sign off on it. So tons of compliance lift. That's the pain that comes with being a licensed representative. Not unlike in the wholesaling situation, the wholesalers are frequently asking themselves, and fix and flippers are asking themselves, does it make sense to go get my real estate license or not? Right? Because the minute you get that license, you've now got all these obligations that you have to honor as a licensed agent. Same thing. Because I've gone the licensed securities representative route, comes with a lot of compliance checklists that I have to honor. So there's no requirement there. Just like, if you call up your stockbroker 20 years ago, you call up your stockbroker, I want to own some Microsoft. He or she wouldn't necessarily have to have any money in Microsoft, right? Same thing. So I don't have to have money in these deals. It's purely me trying to show my investors that I am in this with you. And And then if I were to go become, a general partner and I still have those securities licenses, yeah, I'm going to have to go, all those compliance things. Now I'm raising money for my own deal. I'm going to be held to some higher standards because I am a licensed representative. So yeah, there's a lot of compliance questions that come along with that licensed route. And so it's not the answer for everybody. It was the right answer for me and how I wanted to present my business, but it does come with a lot of onerous responsibilities that a co-GP model or a fund-to-fund model doesn't necessarily come with.
Makes sense. Yeah, it makes total sense. And I've even gone through that same consideration as a wholesaler that you mentioned, right? Being a wholesaler for the past 3 years, my wife and I have considered one of us getting our agent's license, but it's just like, do we really want to go that route? Because then we have to kind of keep that in mind as well. But at the same time, since we have both of us, one of us whoever's not on the phones regularly could easily be the one that gets the agent's license, and then we can have our own small loophole around it because there's two of us, not just one.
I've seen that combo work really well, where one of the pair of the significant partnership gets the license, one doesn't. The one that has the license, you've got all the disclosures you have to do and play by all that, the realtor rules that come with that. But the other one, you've got a little bit more, flexibility in how you approach things. So yeah, I've seen that work really well.
Is that not how you and your wife are? Are you both licensed?
It's just me that is licensed. My wife is actually a CPA, so she has her own licenses that she has to worry about. And but she's not a securities broker. So she had she's our numbers person. She digs deep in the spreadsheets. She loves geeking out on Excel. That's her thing. She loves it. I get the numbers. I prefer to talk to people. But yeah, so that does give us some of that. Sugar House operates under that license premise, and so we don't have that same kind of flexibility. But for her, she could go out and say something about potential returns. I can say nothing about a potential return, right? But if she's representing Sugar House and she says, here's a deal that's coming up, and here's a potential return. One, she's engaged in the activity, so she's not actually allowed to do that. But promising a potential return from a Sugar House project, she's speaking for me. And then that gets my hand slapped. So we have to be really careful in how we talk about these deals. Anytime, like when we get the marketing packet from the operator, it's going to have the projected returns. Before I send that out to my investor database, I have to strip that out. Like, we can't talk about projected returns at all as a licensed securities broker. So if my wife couldn't take that and put those projected returns back in and show it to somebody, because now she would be functioning as a capital raiser. But representing a Sugar House deal. And so we have to be cautious, is how I'll put it.
That's interesting. So if you can't I guess describe or like how you were saying with the projected return, can't share that, how do you even present these projects?
Right. Yep. So caveat. So we can go in there and say, here's the preferred return, right? So most of these deals come out with the preferred return. What does that mean? All right, here's the floor, right? You as the LPs, we as the LPs have to receive that before the general partnership can start taking any distributions. So that's the floor. And then we talk about, well, what have their previous deals done? So, I can't kill you a projected return on this one. I can show you in those numbers kind of how to get a rough idea of what that's going to be for yourself. But then I can talk about, with a caveat, understanding that historical performance is no guarantee of future returns. Here's what previous deals have done. Mm-hmm. Does that make sense to you? All right, cool. I'm with you. Projected returns were this, the actual returns were this, that we expect something similar with this project. So I had to caveat about historical or previous deals, but not tying that specifically to, here are your projected returns for this current deal that you're considering. They really hamstring us quite a bit, and making sure we're not painting this rosy picture to a potential investor and with these deals.
Making sure you're not selling rainbows and sunshine, right?
Exactly. And because that's right. We're all optimistic. I think, most people go in with good intentions, but yeah, you get all excited, like, man, we're going to knock it out of the park here, and we're going to double everybody's money in 24 months. Yeah, that's great. But, if you have to be really cautious when you now somebody's investing with that mentality and you don't perform on that. What liability have you opened yourself up to? As a licensed representative, I opened myself up to quite a bit of liability. So we just have to be a little more cautious in how we approach it.
Man. So lots of red tape when dealing with the SEC, huh?
Right. Yes. And yeah, I get letters from the SEC. I get letters from FINRA, and you see that in the mailbox, and that makes gets your attention pretty quick.
Yeah.
So it's you just like I went this route to try to keep myself, to make sure I could sleep well at night and make sure I was doing things by the book. And they watch it, we get audited. They go back and listen to a few podcasts that we've done. They look at our email. We have to keep all of our emails, and those get logged, and they can go back and look at those. And we get notices like, hey, we saw this, you did this. Here's a little, we flagged this one here, cautious on that statement. All right. So we know they're looking. So yeah, we have to be really, really careful.
So I was going to ask another question, but you piqued my interest again. So what are some of the cautious statements that you've been flagged on before? And does it pertain only to licensed broker dealers, or would that be kind of a statement that would go for everyone?
So in being licensed, the projected returns is one that they're really big on. Anytime that I say, Houston, it is, the fastest growing, the third fastest growing city in the country, and I didn't footnote that, I've gotten flagged for that. I didn't put that source. So they're telling me that I'm hyping the deal by putting in that statement that I haven't footnoted. Where did you get that data? That's the third fastest growing city in the country. They want to make sure I'm using a credible source for making that statement. No hyperbole, right? It's got to be documented.
Wow.
So I would say to that point, that's not a concern of a non-licensed representative. For non-licensed capital raisers, the thing you have to be careful is how you become compensated, right? If you're raising capital, you are not allowed to get compensated a percentage of dollars raised. Flat out, right? If you're getting compensated by the broker, by the operator, a percentage of the dollars you bring in, and you're not licensed, you can get penalized for that pretty significantly, not being a non-licensed capital raiser. So that's the biggest concern for the non-licensed folk. So if you are raising capital, you have to make sure you structure your relationship, your agreement with the operator in a way that it is more. It can't be directly tied to that performance. You've got to structure that a little bit more creatively if you're going to stick on that non-licensed route.
Interesting.
How was that? Was that helpful?
Yes. Yeah. That was good. That was good. And it aligns with, on the flip side of what I've been getting told. I think everybody here knows who Vina Jetty is, but she's been recently putting out a lot of content as well with her and her securities attorney, Nick, as well as a couple other people, but they've been putting out really, really good content, and that aligns exactly with what they've been saying as well. So let's do a little bit of a turnaround, right? Because I feel like a lot of the things that we've been talking about have kind of been like some negative connotations surrounding like the broker dealer and what you can't do, right? So what are some of the things that are pros or positives from being a licensed broker dealer that maybe the general public can't do?
So the pro is it simplifies the compensation. So as a broker dealer, I get paid a flat percentage of the dollars I bring to the operator. So it simplifies my relationship with the operator significantly. I don't have to get written into the general partnership documents. We don't have to go do any true ups on other deals. I don't have to get into the kind of fudge my way into, I have a significant, meaningful, role within the general partnership. I don't have to play any of that creative stuff that happens in that space. It's just a real simple agreement between me and the operator, how I get compensated for that. And then when I'm talking to a potential investor and they understand, they can go back, they can look at brokercheck.org and look at my history and see if there's any red flags, any complaints that have been filed against me. and they understand that I have a fiduciary responsibility to them, to the investor. I disclose how I'm compensated. I'm sitting in that, on their side of the table in this conversation. For me, I feel like that's enough of a benefit as I'm trying to raise capital from these folks, that it's worth the effort of going through the licensing and compliance efforts. Those are the two biggest pros. Simplifies the relationship with the operator and how I'm compensated, provides a lot of credibility and validation to the potential investor.
Mhm.
I like that. That's a really good point. Really, really good point. Because one of the biggest things when raising capital is you kind of have to establish that trust. Like, this can't just be people you're meeting off the street. It can, but it's not likely that they're going to invest just right off the first jump, right? They're going to want to talk with you further, have multiple conversations. But the fact that you kind of already have, like, here's all the resources that we have that you can go and look me up and see that I'm a legitimate person and I'm here in your best interest. So that's a really, really.
Yeah.
So what, let's say I had a deal, right? And I wanted to use your services. What does that process look like? How, like, what is the compensation like range from? Like, let's do just a whole rundown on what that would look like, and let me know what you need from me in order to kind of create that scenario.
All right. Hypothetically, well, hypothetically, we'd be
Right.
looking at, yeah, I'm going to fly out. We're going to go drive around a couple of the deals that you've already done together, with your firm. Spend a day together, spend a couple of days together, driving around and looking at these projects. How have they done? What were your projections and what's actually occurred? Get a real good feel for how your operator group functions. Right. I have to get to know you really, really well before I can go out there and present this to my potential investors. So getting to know your team, the deals you'll have underway, your exits, and then take everything I've learned from that. I have to hand it over to my broker dealer and their compliance department. They start doing some poking and prodding. If we were going to move forward, right now we're going to do background checks. Right, we have to do background checks on the operator team to make sure we're looking for any red flags there that would prevent us from moving forward. Assuming that all passes, we would then start looking at a future deal that we're going to start working together on. You put together the marketing packet for that. I take it to my broker dealer, and they have the compliance team, go through it with a fine tooth comb, get it to a version that I can use in my efforts to send out to my investor database. That's kind of the structure. It's onerous, right? It's a big lift from the operators. They're going to spend a bunch of time with me. They're going to spend a fair amount of time with our compliance team to go through that process. But as far as compensation, it varies. The industry standard is generally somewhere in that 5 to 7% range as far as percentage of dollars raised. How much of that is upfront payout cash, back end equity? That's also part of the negotiations that can happen.
So when you say back end equity, so you could essentially earn equity within the deal for doing this type of stuff.
Right. Yep. Exactly. And that's, for me, I like that. Right. Like, I'm happy to take a chunk of it in upfront cash once the deal is closed. That helps me pay my bills. But then, and then I've got an LP equity position as well. That I'm putting my faith in you to make that more valuable than if I had just taken the payout right now.
Yeah, no, that's incredible. I didn't know that. So definitely learned something there. I thought it was only financial compensation, not equity compensation. So that, very interesting. I like that. And so
part of the creative negotiations you can get into there.
Yeah, no, I love it. I love it. So I'm gonna do two things, and then we're gonna open up for Q&A. So if you guys have questions, just get your hands raised, and we'll start pulling you up here. But I'm gonna ask these last two, and then I'm gonna kind of turn it over to the audience. So you mentioned something about it's kind of a long process, right? A little bit of a heavy lift for the operators. That's assuming that's the first one, right? Now, let's say that everything went well, we checked out. Now it's the second one. Do we have to repeat that entire process, or are we kind of good to go since we've already established that working relationship?
Yeah, the bulk of the work is up front before before we do that first deal. From there, it's going to be more of a deal analysis going forward. I think there might be, every year or every other year we'll do it. We need to do update the background checks again. I can't remember. The compliance team handles that, but there could be periodic background checks that occur, just to look for any new activity, negative activity. Barring that from being the case, then yeah, it's just deal by deal analysis. Does that deal, as long as we partnered with you to focus on multifamily in the Northeast, and as long as you're staying true to that that premise, then we're just going to look at those deals, look at the numbers, look at the underwriting. We have our underwriting team go through it and do our own due diligence on that. Everything checks out, we're good to go. If you come and say, okay, you were our Northeast operator group, and all of a sudden you come to us with a deal in Washington State, like, all right, okay, that's a little bit of a different take, right? So then we're going to have to kind of slow down a little bit. Are we going to get behind that deal? Well, like, why are you diverting your attention over there? Or why does that make sense? And so, we that could slow things down. But assuming we stay within the the understanding of what we established at the beginning, it's just going to be deal analysis and then roll forward from there.
I like that. So last question. Let's say it's kind of the same question, but different circumstances. Let's say because a lot of our audience, right, is newer multifamily investors. They may have invested in other things, but maybe they haven't done an apartment deal yet, or maybe they have 1 or 2 deals. I'm not that much further ahead, right? So we don't have this massive track record, or maybe we have 5 or 6 properties, but none of them have gone full cycle yet. What are other things? Does that kind of eliminate us from being able to work with you, or what is the additional or alternative routes that we can take to kind of establish that trust factor?
What it would take a little bit more time of more effort, just spending time together and understanding your operations and how you guys approach things and your mentality. Because when you have some exits to point to potential investors, that helps me help you, right? That helps me be able to raise more dollars and get more investors confident in the deal and the operator team. That said, we've been good at identifying operators early on who have turned out to be really powerhouse ones. We were on the first group we partnered with, 6 years ago. We're now, I think we're approaching 50 deals with them that we've raised for. We started working with them on their 4th. Another group that we've been partnering with for the last 2.5, 3 years, they're into, we're up to 30 deals with them, close to somewhere around there. We started partnering with them on their 2nd or 3rd deal. So we've been good at identifying, what we saw as powerhouse potential in those operator groups. What has helped us overcome those barriers of, oh, there's not an exit here, or hey, this is a really young group, is they've brought in a key principal, or somebody with maybe another decade of experience with some deep pockets, that has helped us overcome those reservations that might be associated with a younger, less experienced team.
Yeah, makes total sense. All right, well, I'm gonna turn it over to the audience. I mean, I can keep going. I mean, we got another 17 minutes here. He does have to end at an hour, guys, so let's make sure that we respect his time. So I see Luke has a question in the chat, so I'll ask that one for him. But Jada, I can't see the screen very well, so if anyone raises their hand, if you could just pull them up, okay? Luke says, Brad, I might have missed it, but where are you primarily sourcing your capital raisers? Family offices, country clubs, social media. So I think he's trying to get, like, where is your primary source of investors, I think is what he's looking for.
Great question. I have not begun working with family offices or industrial or institutional capital. Not industrial, institutional capital sources at this point. It's been just pure retail investors. So yeah, country clubs. It's people I meet and go out to lunch with. Some LinkedIn efforts. People, it started with people that I have known in just in my own professional endeavors over the last 15, 20 years, and going back to them and saying, hey, I've got opportunities here in this space. I know you're busy, you're running your own business, handling your own W-2 job. Did you know that you can own real estate without having to manage it? And tell them about what we're doing here. So that's been the primary source. Creating some, we try to create a fair amount of content that we put on our website, the lead magnets, doing podcast interviews like this. It's just trying to create our presence out there online as well has been a good source of incoming, potential investor opportunities. The idea of connecting with family offices and some institutional money, working with registered investment advisors who have a big pool of high net worth individuals. Those are some efforts that we're currently looking at to try to bring in some bigger chunks from single sources. So that's forthcoming. But right now it's been mostly just successful high income W-2 earners and successful entrepreneurs. Some of it has been from 1031 money. Most of these deals we can accept 1031 money. So we had a few investors coming into us that way as well. But yeah, that's it.
Okay. I like how you also went into not only where are you finding these, but how are you finding it as well. And I have we have another question from Luke, but I had another question that I wanted to ask about in terms of the operators that you're working with as well. So I know how you were saying, generally you do want to see at least somebody a little more experienced with deeper pockets. Now, is in regards to their general partner team as well, do you look for a certain size range? Like if there's 3 GPs or if there's 6, does that kind of entail whether someone's going to be successful or not?
I don't know if it's the quantity, but there are skill sets that we're looking for, right? There's somebody's got to be really good at the numbers. There's got to be somebody who's really good at managing the management. One thing we've learned over the last year and a half, there's got to be somebody who's really deeply familiar with the loan docs. It was one thing to go out and get a loan, but what we saw was there hasn't been a full meltdown across the market right now, but there are operators who are in trouble in some of these deals, who are having to sell under distressed situations. And what we've seen is a lot of them didn't really understand their loan terms, their loan covenants, what failing to hit a specific DSCR, debt service coverage ratio number, what that would trigger. And so we've added another level to our due diligence on the operator teams, like who on your team is the loan doc finance expert who really understands the financial paperwork in and out. And so it's a skill set checklist as opposed to a quantity checklist. But it's we mean these are complicated deals. Not everybody's going to be good at everything, but so that's why it does need to be a team approach, and 3 to 4 is kind of a minimum of what we've seen where the GPs can cover all these various requirements.
Yeah. Interesting. And then Luke had another question as well. He's asking, what is your stance with bringing family into the loop? At your level, you've definitely stacked up enough successes to back it up. Maybe driving some self-directed IRA funds towards deals. Do you tend to stay away from mixing family and business?
My family's a little unique. Sweet. I love bringing the kid. Right here's bringing family into the business right here. Joseph's doing it. Nice.
My right here.
There you go.
Capital raising queen.
Perfect. Bring on the money. I would say it's just that's very personal. You've got to understand those going to those conversations, knowing that things don't always go as planned, and if it doesn't go as planned, is that going to put this relationship at risk? And so if you have an iffy relationship with your brother who wants to put in the money and then the deal goes sour, what's that going to do to your long-term relationship when you're going to keep on seeing this person at family reunions? So it's very personal. My parents were never going to be in a position to invest in these kind of deals. My dad's a school teacher, right? I've got most of my brothers have stayed pretty low income. I've got one brother that outshot the rest of us. He's an endodontist, plenty of cash. He and I talk about these kind of things, but again, our family isn't that super close. And so it's, does it make sense to mix it? I would take his money. There's no hard no at this point, but you have to be really careful with these relationships that you're going to continue to see outside of business functions. I would just be really careful making sure they understand this is business. These things, they're not foolproof. There are some operators that have, had to sell at a distressed level and wiped out the investor equity. That can happen, right? Can that relationship with your family member survive that? Family is more important than anything. So don't risk it just for getting one more LP into your deal if you don't feel like it can survive a bumpy operation.
Oh yeah, those are great insights.
Yeah, it's very personal. But then self-directed money, yeah, these deals we do take. Most of our operators do accept money from self-directed retirement accounts. They're kind of a pain in the butt, right? Because there's all the paperwork that comes with that, and all the you've got 160 pages of a PPM, and now you've got to go do the read and approved on each signature line, and then send that over to your custodian to complete, and then they send that back, and then they wire your money over. It's a bit onerous. In IRAs, you have the UBIT, the UBIT tax consideration. So is it really the best place to put an IRA money? You have to make sure the investors understand that. Where a solo 401k, they don't have that UBIT consideration. And I know that's a weird term. If we need to dive into that, we can. So solo 401k, when I'm talking to a business owner who has a solo 401k, yeah, I'll take that money all day long. That's simple. Self-directed IRAs, the UBIT consideration is something that we really have to make sure they understand. Basically, the bottom line of that is you can expose that IRA to having to file a tax return and pay a tax on a portion of the returns. And you just have to make sure they understand that IRA may have to file a tax return. So you have to walk them through that. So yes, we will take self-directed account money, retirement account money. Just understanding it is onerous to go through that paperwork process, and then that potential tax consideration, you have to make sure that's disclosed. But yeah, I think I got that one. Anything?
Yes.
That's
Let me
actually.
know if there's any follow-ups to that one.
Oh, I see Max has got a question. Let's do Max.
Bringing you up.
Appreciate you coming on. It's very, very good information and insight.
Thank you.
But I wanted to ask about, coming from the broker-dealer side, what are your thoughts and perspectives on the fund-to-fund business model? And what kind of pitfalls can early investors really look out for? Yeah.
I've looked deeply into the fund of funds, and I've had some colleagues go that route, and because it can keep things simpler. The pitfalls, the fund of funds, right? So now I'm going to go start Sugar House Investments Capital Fund 1. And that I'm going to go out to my securities broker or securities attorney. He's going to help me set up that fund. And I'm going to have fees associated with that fund. And then I'm going to go raise capital for that fund and then go place it with these type of deals. And those, so what you end up having is a second layer. That fund to fund models adds a second layer of fees that can ding the potential returns to the investors. And so, the way you get around that is you then go to the operators and try to negotiate a better return, saying, "Hey, I'm bringing in $5 million in one fell swoop to you. We want this group, this to have a separate share class and get a better return than somebody who's just bringing in $50,000, right?" And so then I can then go back to my investors and say, "Yeah, my fund has a fee to it, but I've negotiated a better return for you." And so then we make it a wash. So the fund to fund, that your fund will have fees to it. So you have to be aware of that. And then, how blind are your investors going to be in the potential deals that you're going to go use that money and invest that money into? Meaning, in that fund of funds, how much flexibility do you have to go place your money with Joseph, or a different operator over here, or a different operator over there? Does it have to be tied to a specific asset class or specific geography? So the way that we approach it is an investor isn't committing funds to us until we have a specific property that they're going to invest in. So they know exactly what they're putting their money into. With the fund of funds, you remove that visibility, right? It's you can call it blind or semi-blind, depending on how you structure that fund and put the parameters in place of what you could potentially invest in. So some investors are fine with that. Some investors don't want to put money in unless they know exactly what property they're going to be in. So you just have to be ready to overcome. If you go that fund to fund model, you have to be ready to overcome that objection. Like, how are you going to structure that investment thesis to a way that it makes your potential investors comfortable with putting money in there in that fund, while you will go out and then identify the properties that you're going to go invest in. So not necessarily pitfall, but just two considerations: an extra layer of fees, and then overcoming that blind level of blindness for the potential investors.
Yeah. Awesome. Thank you.
Good thoughts.
So do you work with more syndications?
Yes.
Okay.
Primarily, yes. That's how we function. When I talk about operators, I'm using that synonymously with syndicators.
Interesting. Okay. Another question for you, and I guess with in regards to what operators you work with, or I guess mainly what opportunities you work with. Do you have a specific unit count or class count? Like what kind of opportunities do you look for?
Yeah. So at this point, of the operators we partner with, the majority are in multifamily. We have one that we partner with in self-storage, one is in mobile home parks, and one is in industrial buildings. We've had opportunities, presented to us with ATM funds or some office and retail, so those opportunities exist. We haven't felt comfortable going down that route. Multifamily is really popular. Everybody's lived in an apartment. We all get it, right? We understand the basics of how that works. As far as dynamic from there, like in the multifamily space, about 150 units and above, right? Or B to B plus class and above. We're not looking for deep turnaround projects. We're not looking for new construction. We're looking to go in and buy an asset that's already performing, right? It's already generating cash flow. We just want to go in there and optimize it. So we're not looking for C class, D class, real big, heavy lifts to go in there and turn around a project with all that, significant potential returns, but also significant risks that come with those. So really pretty boring, tried and true, a size of an asset that, there's an on-site leasing center. There's full-time employees there on the property that handle the tenants and the maintenance and those kinds of things. Just pretty tried and true, a proven formula that's a conservative approach that we can tell our investors, month one of owning this thing, we're all going to get distributions. It's already performing at this basis. We're just going to go in there and optimize it and bring it up to here.
What about new construction? I know you mentioned B's and A's, but you didn't say anything about new construction.
Yeah. I mean, we look at it. We've never done it. Again, the idea that going in there, you can make significant returns, but you're not going to see any distributions for 2 or 3 or however many years it takes to build that thing out, lease it up, and sell it. And so our investor pool has not been super favorable to that idea of putting in money and not seeing any returns for years down the road. So we haven't really pursued it. I mentioned that first deal that I invested in just personally before I even started Sugar House. Went down in, a couple hours south of Houston. That one had a new construction element to it. And that was part of what made that one go really poorly, because the zoning wasn't right. The permitting wasn't right. The buildings got 2/3 up and, built. And then that Hurricane Harvey came through and knocked them all down. It was painful. And so our thesis has been, let's just stay away from it. There's opportunities to generate really good returns without having to go through those hassles. That said, I know we're leaving money on the table because I have colleagues and I associate with people who are on the development side and they're crushing it, right? So it's there's nothing wrong with it. It hasn't fit within our thesis.
And just for clarity, Brad, that is a personal business model and your investor client and database, right? That's their risk profile and
Correct.
your risk profile.
Yeah,
right?
You're exactly right. You're exactly right. Yeah, I have nothing against new construction, and if you're going in that route, I'll cheer you on. It's just where we're at and what our investors' risk tolerance. It hasn't really been something that we felt like we need to pursue.
Man, really, really great stuff, Brad. Honestly, man, like this was very informative. I'm sure a lot of people got a lot of value out of this. I want to make sure that we're respectful of your time. I know you only had the hour. So at this point, it's time. Fast. Any shameless plugins that you've got, like whatever you're doing or want to promote or anything at all that you've got going on, like now is the moment. I think Jada put your website in there in the side chat already.
Thank you.
So anything else you got that you want the people to know, how can people reach out to you? Do you want them to reach out to you? All that good stuff.
No, absolutely. You guys are the movers and shakers, right? You guys are the ones out there hustling and finding these deals and making it happen. So my hat's off to you guys. You guys are in the trenches doing it. So cheering you on, cheering you on, cheering you on. Always happy to connect. Sugarhouseinvestments.com is the best place to find me, see the kind of deals that we're working on, and connect. I'm always happy to jump on a Zoom call and discuss any projects. I do like hanging out on Twitter. There's some really cool real estate conversations happening in Twitter. I'm at Brad Shep on Twitter. Always happy to connect there as well. So yeah, sugarhouseinvestments.com is my shameless plug, but more so hats off to you guys for being the ones that are actually going out there and making these deals happen and putting the stuff together. You're doing the hard part. So kudos to you all.
Man, well, thank you. Thank you so much for joining us. All of the information that you're getting. Feel free to go. I know that the time crunch. So thank you so much, Brad.
All right. Thank you. I appreciate the opportunity. Have a good afternoon.
Thanks so much, Brad. Have a good one, man. And what a great one. All right, Jada. Stop the recording and start the tunes.